Hello and welcome back to Hypofriend, your favorite channel dedicated to helping you find and get the right mortgage option. My name is Luca and today we're going to talk about whether you should buy your property now or should you wait in Germany. To help me break down this topic, I have a guest, Dr. Christian Mulder, who is a former senior manager at the IMF and World Bank and more recently co-founder and CFO at Hypofriend. Chris, great to have you on board.
I'm happy to be here, Luca.
Well, let me jump right into it. The first question that I have is really to help the viewers understand, and myself as well, frankly, how did we get to where we are? How did interest rates increase so much in the last year and a half, and where are we right now?
Yeah, good issue, Luca. Indeed, we're a little bit in exceptional times. I mean, what we experienced over the last two decades, basically, was interest rates coming down to the point where the government borrowed at negative rates. Lending rates were on the order of 1% for your mortgage. It was almost felt like paradise. And then in a very short period, interest rates shot up. And what is the reason? Well, the Ukraine war. What happened? Ukraine is in essence a large supplier of big commodities like grains, but more importantly, the boycott of the natural gas exports and the pipeline combustions from Russia basically drove the natural gas price up to at the peak about 16-fold. And to put that in perspective, the natural gas price increased to like about 5 times the price of oil. Yeah. And so the crisis, the depth of the crisis was actually far worse than the oil crisis that we had in the 70s. So that drove up the prices, and then what you get, then the ECB, the European Central Bank, steps on the brakes and says, okay, we need to raise the interest rates and to slow down. But they stepped on the brake a little bit too slow, and then when you brake in the beginning too slow, then you have to slam the brakes harder. And so what happened? After the high prices, we got wage inflation. So the wages went up to catch up, and then the wages translate into higher prices. So we have this wage price spiral.
Right.
So what we now have is basically the European Central Bank overreaching. Interest rates have shot up to about 4% on the short term. And that's where we are.
So you mentioned the short-term rate is 4%, but what about the long-term rate?
Yeah, so the long-term rate, we're currently at about 2.6%. 2 weeks ago, we were around 3%. Why it went down? Because the market is thinking we're more or less peaking. Now, what we're talking about is the 10-year government bond rate. Yeah. So the government bond market is more or less the deepest, the most efficient financial market that you have in the world. So that rate is actually lower than the short-term rate. Yeah, and that is a sort of an unusual situation. And that typically indicates that the market is expecting the short-term rates to come down quite significantly.
So you mentioned market expectations. Now, I'm sure a lot of people out there who are in the market to try to buy a property to get a mortgage are trying to anticipate where the interest rate might go and maybe use that information to help decide whether they should move forward now or later. But commonly, what mistakes do people make when they try to predict and anticipate the movement of lending rates? Yeah,
so a lot of people have the same anticipation in a way as the experts that these rates are coming down. The short-term rates at 4.5%, we don't expect that it will last for much more than 1 or 2 years.
Yes.
Yeah, and so they will come down. The mistake that people make is that they think that therefore the long-term rates will also come down. Yeah. Now that market is efficient, and for certain technical reasons, the bond market expects rates to come down by 0.1, 0.2%, but not much more than that, because they already are much lower than the short-term rates. Yeah, so that is one big mistake. So the other big mistake is that people they look at the recent history and the wishes of the father of the thought. They hope that the interest rates on lending go down to where we were like 2 or 3 years ago, like at the 1% level. And that is unlikely to happen, because what also happened during the crisis, the corona crisis, and then the subsequent war, is that the governments have started to borrow much and much more, particularly in the US. Yeah, and that will have a lasting effect on interest rates. Those deficits won't disappear soon. So to sum up, the big mistake that people make is to think that interest rates will come down quite massively.
Right.
They may come down a little bit, but definitely not massively.
Right. So if the ECB rate goes down 1 or 2 percentage points, that will just have a very, very small effect on the price of the 10-year bond, and lending rates will only go down, as you said, maybe 0.1.2%. And you think that's likely to happen in the next 1 or 2 years or so?
Well, the thing is, this market is also volatile, right? So we expect rates to come down. So that is the expectation of the average. But there is a lot of volatility around that average. Like, as I said, the rates a couple of weeks ago were 0.4% higher in the bond market. Yeah, so there is a lot of volatility. I don't have the crystal ball to say it's going to happen exactly this way or that way. The trend is a little bit down.
Instead of getting a little bit technical with interest rates, I would prefer to shift the topic a little bit and talk about property prices. Because in 2018, 19, 20, 21, people could get a mortgage at a rate of like 0.9, 1, maybe 1.5% at later stages. Now it's, or as you said, around 4%. So given that increase in interest rates, how have property prices moved?
Yeah, so let's first talk about the property market a little bit more broadly in Germany. So basically, a lot of people think that the market has gotten very overvalued because they focus on the last 10, 15 years where prices really run up. But what people overlook is that in that period before, and certainly during unification, prices actually went down when you look in real terms. So over a 50-year period in real terms, i.e. corrected for inflation, prices haven't moved that much. Yeah, and so there is no reason to believe that the market is seriously overvalued. Yeah, and what we've seen in the last year and a half, we see prices coming down by 5%. Now, we see quite a few different data that show that it's 50%, but the data are notoriously bad. The most reliable sources, in my view, show a decline of about 5%. So we see a little bottoming out of the market.
Interesting. So do you think that moment where prices may start recovering, start increasing is approaching?
Yeah, and I think we're reasonably at the bottom. Again, I don't have a crystal ball, but one of the reasons why the price may also be bottoming, because you see rent prices are increasing. Also, it's not that construction new build prices are lower. No, they actually remain very high because of the cost of construction, the scarcity of land, etc. So I don't see much reason to expect lower prices. And then in the context of the interest rates, right? So maybe interest rates come down by 0.1, 0.2%, but that saves you 1 to 2% over the next 10 years, right? And maybe house prices go down a little bit, but they may also go up. And it's actually a good time to what I call to go bottom fishing.
Bottom fishing. So it's a buyer's market now. You can negotiate very aggressively. More properties on the market. So people should, in other words, bite the bullet, get a slightly higher interest rate rather than expecting things to improve quickly. That's sort of the message that I'm getting here.
Yeah, and the thing is, it's very hard to time the bottom of a market.
Right.
Yeah, and think about like 2-3 years ago, people were bidding up against each other for properties. There was a deal scarcity. Right now, indeed, as you say, it's a buyer's market. You can go and search and then negotiate. You can find a good deal, and that may save you 5, 10, 50%. Yeah, and that is far more important than kind of trying to fine-tune the exact time in the market or save yourself 2 or 3% on interest rates over the next 10 years. Yeah, because after all, we don't know if interest rates, in a bad luck situation, they may go even up again.
Right.
Yeah.
Well, there you have it, folks. I guess waiting for interest rates to go down, waiting for the market to be similar to what it was back in 2018, 19, 20, 21, will probably not give you as much of a benefit as simply reducing your property price, negotiating aggressively, taking advantage of the buyer's market. So, Chris, thank you for your insights, and also thank you for kind of holding back and not going into too much detail, not being too technical. That's appreciated. And if you like the video, please leave a like, comment, subscribe. It's really appreciated, and we'll see you next time. Thank you.